Today is September 3rd, 2020. Tesla down just about 10% this pre-market, with the S&P 500 being the most overbought since 2018. And yet, the dividend yield for the S&P is at its lowest point since 2007, since before the financial crisis. The market cap to GDP was, I believe, 150% to GDP less than a week ago or 2 weeks ago, and now its market cap to GDP is now at 185% to GDP. So clearly, to top off this video, clearly we're seeing a huge divergence in reality and perception of reality. And of course, like I always say, we have the Fed to thank for entirely for these divergences in traditional market relationships. Private payrolls actually saw a rise of about 428,000 in August, but it's below. By the way, this is according to an ADP. Actual numbers come out in literally like 20 minutes or so. But it was below a 1.17 million expectation for new jobs, but we only got less than 500,000. So most of these jobs, these new jobs, were in things like in sectors like hospitality and education and healthcare, and these large businesses. They created the most jobs at roughly 300,000. So the vast majority of the new jobs, private payrolls in August, was created by the large businesses, right? So I'm going to have some charts to compensate for that soon. And by the way, not only that, but if you take a look at France and Spain, okay, France and Spain, starting with France, their PMI, business activity index, fell to 51.5 in August from 57.3. Okay, it's currently at 51.5 from a 57.3 high. Okay, so right, their business growth is contracting while job cuts are accelerating. So there's clearly taking into a vast effect in their overall production, in their manufacturing, and their activity. And of course, Spain is even worse. Their PMI reversed lower due to things like fresh outbreaks in COVID. And also what helps is the Eurozone retail sales actually came out, which was actually fell at, I believe, 1.3% in July. Spain's recovery basically reversed. Not so much because of the retail sales. That's more of a Eurozone thing. But Spain, in essence, because of the fresh outbreaks in COVID, and because, in direct result that the tourism attraction is far, far less, next to zero, and they have a humongous tourist market, and it's basically vanished because of COVID and fresh outbreaks. So they're seeing the largest contraction of them all. Of course, the Turkish lira, right? The Turkish lira, or its lira, whatever, falls to its lowest. Right, this Turkish currency, it fell to its lowest level on record against the U.S. dollar. I believe at around 7.4 or 7.5. While their inflation rate was 12% year over year in August. So the lira depreciated more than 5% against the dollar in August. And it's almost down 20% or so for the year. So we're seeing day by day humongous moves and price swings, and crazy equity valuations, wildly broadening credit spreads throughout entire financial markets. So this data that I just shared with you, and I'm gonna share with you some charts now, is primarily the reason the fact that we see these kinds of broken relationships appearing every day, it's extraordinary and it's horrifying to watch. So let's go ahead and share the screen here. So you should be able to see, this is just a PR from the Fed. I believe the St. Louis Fed. But I highlighted this, I'm just going to read it out loud. Total number of people claiming benefits in all programs for the week ending August 8th was 27 and change million, a decrease of 1.04 million from the previous week. All right, so we have over 27 million people still on unemployment claim, still on benefits. All right, and we fell approximately, just over 1 million jobs were unclaimed in just a week, and there are 1.64 million people claiming benefits in all programs in the comparable week in 2019. So 27 million in claims versus 1.6 in initial claims. So in last year, of course. So it's it's a crazy time, just to put it in very blunt terms. 27. I mean, there's still so many jobs that are claimed unemployed, and most of those people are, and whether it's whether it's payroll or non-farm payroll, or there's a lot of people that are on furlough, and a lot of those furloughed people are going to be permanently fired. They're going to be permanently released because businesses are realizing very quickly that they can take the majority of their business online. They don't need to rent out commercial spaces for more square footage, wasting cash flow reserves on these square footages when they could just conduct business online. It makes so much sense. It saves a lot of money, especially in times like this. So it only makes sense that claims are only going to rise from here on out. As we can see, well, actually, that's not what I wanted to show. Here we are. So, here I have, this is also from the Fed, right? We have our initial claims in the red line, while we have a 4-week actual moving average of the initial claims. So typically how the moving averages work in initial claims is there's a 2-week, it's balanced, so it's centered. So 2 weeks is from the previous 2 weeks of initial claims, current initial claims, and 2 weeks is actually forward-looking, which in essence balances out the data to create the 4-week average of initial claims. So clearly, the average of initial claims so far this year has been, throughout the pandemic, has been trending above actual initial claims. There was only 1 week where we hit just under 1 million. I think it was 971,000 claims. And, we've basically been at the 1 million claim low range for, the better part of a month or so. And it's, if we take a look at this just in perspective, take it back to 1960, I mean, just look at that. It's kind of crazy. Now, in terms of our production, or industrial production, we've seen, post 1945, after World War II, we actually saw like the worst performance in production, right? Because everybody was broke, nobody was paying their income taxes, it was too high, disposable income rates were through the roof. So there was nothing left to make, there was nothing left to produce, there was no demand for production. So what happened? Production literally fell to all-time lows in September of 1945. To change of about -10%. However, if we look at currently our pandemic structure, the IPI is actually more impactful than what happened in World War II, because it actually fell 12, almost 13%, our industrial production index. So obviously we've rebounded from the low in March, or sorry, excuse me, in April, and currently we're back and above zero, kind of so far confirming that yes, we've finally resumed at least some production throughout the nation, whether it's gathering production through third-party resources or through a vertically integrated company, and that's what we hope. It's vertically integrated. We don't want things to be subsidized from the government now. So I believe there was one last thing here. Nope, that was it. That was it. In terms of, maybe I'll just show you my screen here for Thinkorswim. Let's see what I can do here. Yes, let's share the screen. Hopefully you can see it. So I have here, basically I just check all the low float small cap stocks to see if there's anything moving that I could expose for arbitrage opportunity. Nothing's moving quite yet. I think if I were to just check my watch list here, see if there's my speculation watch list. Actually, there was an interesting mover that was on the pre-market scan. Yes, AKBA. I mean, it's in the matter of overnight, it's at its 52-week low from almost its 52-week high. Is trading at, well, not really, but unbelievable price swing overnight. Basically did horribly in their, their drug candidate. I think it was a phase 3, and the phase results were not at all favorable. So they didn't reap any forward-looking expectations, so everybody withdrew from their stock. ADMA also a little bit of action, not so much, but enough to actually spice things up maybe. Not a whole lot of volume trading. Money's not even coming in necessarily, right? And well, nothing's really moving, so we might as well not waste our time anymore. So there you have it, everybody. This is Max from Finance Nerds. Brief disclaimer, we are not financial advisors. Anything that we say you must not take seriously at all. Don't take anything I say seriously. This is primarily for entertainment purposes only. Again, we are not investment managers. We're not financial advisors. We do not represent anybody or anything or any firm except ourselves. So please trade at your own risk, and we will trade at ours. Okay, thank you. Please like and subscribe for more future content. This stuff is only going to get better and more exciting and more thrilling. So I hope to see you in the next video. Bye-bye.